Uh, Good morning. I'm not going to take attendance today. Count everybody as present. I apologize for Monday, but I really had to go to the doctor. I normally avoid going to doctors, but sometimes you gotta. Since we'll be finishing up chapter 11 today, I'm going to postpone the exam to next Wednesday instead of Monday. So let me write that here. I will do a Zoom only review session. Uh, this Friday at 4 p.m. and next Tuesday at 4 p.m. as well. Okay. You can come in as you like, and I'll post the recordings of the Zoom session if you cannot make it yourself. Now let's finish up chapter 11. We already talked about the concepts of risk and return. We especially talked about uh, efficient, inefficient portfolios, the efficient frontier. The all important principle lesson from the efficient frontier is if you want higher returns, you have to be able to face higher risks. In this last part, we're going to talk about two major things. One is systematic risk principle and capital asset pricing model. Uh, as we have talked about minimum variance portfolios, you can always improve on a non-diversified portfolio by combining it with a diversified portfolio. Both if you give me a non-diversified portfolio, I can find you a combination of that portfolio and another diversified portfolio that's going to give you better rewards, expected returns, and less risk. This means non-diversified portfolios will not be efficient or they will be inefficient. Now, let's think about two kinds of risks. One is called asset specific, or fancy term for that is idiosyncratic risk. These are risks that affect only one or a few uh, assets or stocks. Let's think about it. Uh, you know that NVIDIA has a very successful CEO, this Korean guy. What was his name? Huang. And suppose, God forbid, tomorrow we got the news that he got assassinated by a rival firm. Okay. Do we expect that NVIDIA is going to be affected adversely by that? Yes or no? Yes, that is normal. How about Coca-Cola? I mean, other than feeling sad about the guy, do you really think that Coke investors are going to care one way or the other whether NVIDIA is going to have a different CEO now? No. So this is an example of as a CEO taken out, this would affect only companies in the AI chip business, but not the entire economy. Which means if this portfolio, if this stock or these stocks are already in a diversified portfolio, the effect on the entire portfolio itself is going to be rather limited. Alternatively, systematic risk, these are risks that affect in varying degrees uh, most, if not all assets. If tomorrow Fed had an emergency meeting and decided that they're going to increase the Fed funds rate by 1 full percentage point, is there going to be any company that's not going to be affected by that? Do you think? Whether or not you're in the money business, obviously banks will be affected. Construction companies will be affected because that's going to have an impact on mortgage rates. Uh, but overall, even Coke will be affected. Why? If interest rates are higher, um, construction business is down, more than likely economy is going to be in a downward mood. That's going to decrease consumer confidence. So that's going to decrease demand for all products. One thing about systematic risk cannot be eliminated through diversification. On the other hand, asset-specific risks, they can be either eliminated or reduced to a minimum. In a sense, asset-specific risk or idiosyncratic risk is a risk you don't have to bear. I mean, if you want to have a portfolio that's comprised of only NVIDIA, you are taking that risk. But we also know that that is an inefficient portfolio because we can do better, both in terms of expected return and risk. On the other hand, you cannot get rid of systematic risk through diversification. I mean, depending upon your choice, you can be subject to a lot of it, or you can be subject to a little of it. But it's not going to be zero. The only asset that will not be affected by systematic risk sources is the so-called risk-free asset, such as very short-term treasury bills. I mean, if you got treasury bills that are gonna mature in 3 months, it doesn't affect you too much whether or not Fed funds rate is higher or lower. Hence, only type of risk that will be and should be rewarded by the market in terms of higher expected returns is systematic risk. Because if you're taking idiosyncratic risk, you can get rid of it or you can reduce it to a minimum through diversification. Why would the market reward you for that? You know, it's like I sent you to do a job, okay? And, you know, giving that example of you're given the job of assassinating somebody, you know, you can go ahead and use a sniper rifle and get rid of the guy, or come in hand-to-hand combat with a sword, kill the guy. Should I reward you because you were heroic? No.